All right, so the dollar index, this is our daily chart. The idea is that we were looking for a bullish dollar. We've been bullish on dollar for a while now. And I was mentioning that we would go for the full 100 level. We hit that. I mentioned we would go to 101. And I mentioned how we could probably draw back down in after hitting 101. That's one of our targets. And the second one was going to be 101.947. And just for clarity's sake, the other one was just short of 103. I'm not calling a top here in dollar. I don't do that. I'm staying with the underlying narrative that dollar should keep getting pressed higher. This is just in my mind right now, until proven otherwise, just a retracement after hitting another premium level. Now, what changes my mind on about the dollar being bullish? If we go below these lows in here, that to me signals a potential turn or intermediate term high forming in the marketplace. And it would take a little bit of time even after that for me to change my long-term bullish stance on dollar. So what am I saying in short? I'm allowing for sloppy price action, as I mentioned on Monday night's commentary. And I'm not in a hurry to make decisions about actually going in and taking live trades again yet, because we just came off Passover. There's a lot of holiday volume, and a lot of money stays on the sidelines during that week. I know it may not seem practical to some of you, but it's true. So we have to work out that little bit of lull in the volume. So higher prices on dollar, that's what I'm looking for until proven wrong. And we've obviously seen two targets here hit, the 100 level and the 101 hit rather handsomely. So I have that level highlighted here. We'll drop down into the hourly chart now. Okay, you see how we moved up in, hit the 101 level. Look what they left here. See that? See how clean that is? Price does not like to leave those types of formations in its wake. So in other words, even though we had a market drop, even though we took out a swing low, even though we had a fair value gap, even though it came up here and filled it in, look at the bodies respecting that. It's beautiful. Yes, there's a little bit of movement above it with the wicks here, okay? But the bodies, look how it's telling the story there. That is algorithmic price action. If we look at the high and the low, that whole price swing here, from that low up to this high here, that parent price swing, if you put a fib on that and find out 50% of that, it's going to put you about in this area. So I'm eyeballing it, but ultimately right below that low. So we have a break in structure here, fair value gap here. The volume of the move is inside the bodies of the candle. See that? We always allow for some inherent price action with the wicks and the tails of the candles, but we're looking for the underlying narrative. It's likely to go back in here and fill this one single candle that created that imbalance. This candle's low, this candle's high, that small little imbalance right in here, it goes up and fills in that, spends some time there, then breaks aggressively, attacking all the stops below here, 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 fills in the gap, and then goes right below that low. Why? Because equilibrium exists between this low and this high. Why did it drop like this? Because it hit our second target of 101. And plus, it's 100 points or pips above the full 100 level. Where's it at? Good grief. Here it is. Okay, so we really stretched above it, and then we had this. Now, to me, this looks a little bit like them trying to produce this sentiment idea that the dollar has topped. I'm not convinced of that yet, okay? It could, and I could be absolutely wrong, and these highs are maybe the ones that top the dollar. That always exists. That's where I can be wrong. I don't mind being wrong by not trying to pick tops and bottoms. I don't mind that. It keeps me on the right side of institutional order flow. Institutional order flow is rooted on higher time frame bias, okay, and that being for the dollar, it's bullish. Well, it's bullish in my opinion, let's say it that way. So while I don't subscribe to the idea that we have topped here, I like the idea that we came back down into this run, and it looks like for everyone else that may be looking for resistance ideas and a break in the market structure and a break and retest idea. I don't think it's that simple. I think that we're going to revisit that 101 level, and we have unfinished business above it. That means it's likely to go a little bit higher than that. That's what I'm subscribing to right now. I'm not convinced at all that we've changed gears. Do not try to pick tops and bottoms. You don't need that. There's a lot of opportunity between intermediate term highs and lows. All right, so 15-minute time frame, we finally made it. Sell side liquidity resting below these lows in here, swing low, and we had sell side resting below here as well. So as I mentioned, too clean up here. They're really building the idea that this is resistance. I don't think that's the case. And we might want to go a little bit deeper. If it retrades back, let's go back up to this here. We could trade back to the 100 level, maybe sneak below it just a little bit to make everybody think this is really done. All right, so here is that hourly fair value gap. But now look at it with the lens of the 15-minute time frame. So we have this area here, but then we have this imbalance right there. So it comes up a little bit deeper, closes that in. What do these two up close candles represent a bearish order block. So we can use the low of the lowest up close candle and its opening price. You draw that out in time, hammered it. But why are these candles here on order block? It's because we had the change in the state of delivery where it's already dropping, then it goes higher. So the algorithm is putting a kind of like a bookmark. Okay, this is where it will want to refer back to in the future. Okay, it's like a reference point that the algorithm will go back to, because the algorithm doesn't know where your specific stop is at all times. Your broker does, but the algorithm doesn't necessarily know where your stop is or my stop is at any given time. But it's based on the logic that is really promoted and regurgitated all the time in books and seminars and course teachers and things. Put your stop rate above the high. Put your stop rate above the highs. It's always the same thing all the time. And it doesn't take, a rocket scientist to sit down on a chart and say, yeah, well, if it's been dropping, find a short-term high most recently, and that's where right above that, there's going to be buy stops. For anyone that's short, they trailed their stop loss down. So what does that mean? It's like anyone that went short up here and was fortunate to be right, and it does this move here and starts to break down, their stop would be moved from here to right above this short-term high. That trailing stop loss mentality. But this order block here is a change in the state of delivery. It's been going lower. It's likely to go lower. This displacement qualifies that order block because it creates a fair value gap. And the narrative is likely to go lower. Now, this lower movement is short-term in nature. It's counter long-term bias, okay? So here's the hourly chart on Euro. Market traded down aggressively here on this day. Swept below that low. Here's that daily low. Let me go back that way because I've done a lot of talking, probably didn't make note of it. That daily low is 1.0806 in 1 pipette. That's that line right here, okay? So on an hourly chart, it breaks down, slams below it, and then look at all this price action in here. This is during Passover week, last week when I wasn't trading, and we hit that same low here. We rally, create a fair value gap there, run right back up to the old highs in here, and optimal trade entry. From the high to the low, we went right up into a short-term premium. So as a short-term trader, going counter trend, remember I was referring to on a dollar index where I have students that are contrarian. If I'm long-term bullish on dollar, they know where to go in and pick their shots where it looks like retail will see it as a reversal, and that's how they made their model. So I'm bullish on dollar. They'll wait for retail to think that that bullish dollar has topped, and then they'll go in and find their setups. So hopefully that made it more clear about what I was saying earlier. Well, what would that look like with Euro? Well, it would look like this. We would have a run back down into old support, which is an old daily low, rallies, creates a fair value gap, buy it in here, right back above the bodies of these candles into the 62% retracement level, because 62 and 79% retracement levels are what I teach as optimal trade entry range, but it's not optimal trade entry for the setup. Okay, so in other words, we could be a buyer down here and trade back up to the 62% retracement level, or the bodies, okay, round above the bodies of these candles here. Just pick the 62% retracement level and just make it really easy for yourself. I don't have a bias at the very moment for Euro. In other words, I don't have a clean level where it's going to go to and then reverse. Okay, I've been specific recently, and both communities have known that. But right now, we're back in that sideways consolidation congestion area, and we have to wait for displacement. And what does that mean? Wait for something like this. Okay, if we get it on the upside, okay, great. That's fine. It'll give us something to work with in terms of a range. If it breaks lower, that's fine. It'll give us something we can work with in terms of a range as well. What do I mean by that? Well, from this high to that low, we went below these lows in here, and then we created a short-term break in market structure here. So this low, broken, came back down in, filled the fair value gap, spent some time in here, a lot of time. Okay, this is typical with a holiday. And then starting into a new week, it's slow volume, and then we get this little bit of movement, and then we pump right back up into this range, high and low. 50% of it's like right here. Above 50%, we're going to be looking for a premium. So 62 to 79% retracement level, that would be your objective. So if we get a displacement lower, I'm going to look for this type of move here, just repeated later on. Vice versa, if it goes higher, I don't care at this point because it hit my objective. My objective was I wanted to see Euro go below that low. Okay, this level here on the daily chart. Since it's done that, and I am neutral near term on dollar, I'm still long-term bullish. But right now, I don't see a setup to go in and say, okay, now there's something to do. Let's go on to the euro dollar, 15-minute time frame. And you can see here, again, really nice fair value gap. This is what I was referring to on the hourly chart. It's just really clean here on the 15-minute. Now, when I say clean, what do I mean by that? We have a nice run up here. It returns back to that old daily low. And then we have what? Displacement. That real energetic run higher. That is algorithmic. When it creates this gap here, we don't care that it's still stretching up here. No. What's the narrative? We're short term right now, oversold on the daily. Why? Because we took out that old daily low. We went below it. So now it's taken what out of the marketplace? Sell stops or sell side liquidity. So what's the market going to look for now? Buy side liquidity. That means it's got to go higher to get that. So an energetic move off that same daily low, and it creates that displacement. When it trades back down into that, I'm thinking, okay, well, it's created this short-term high. It's going to want to run back up into that. But even if it doesn't, if I just get above the bodies of these candles in here and reach up into that 62% retracement level on the hourly chart, as I mentioned right before I transitioned to the 15-minute time frame, we reached up into that 62% retracement level. So that would be an opportunity to be a buyer here and sell short, not sell short, but sell your long there and be done. All right, so we're dropping down to the hourly chart, and here is the E-mini S&P June contract. Market traded down into that short-term low, ran out sell stops here or sell side liquidity, so it purged that liquidity. Then we had all this sloppiness starting the week, and then we dropped down and then rallied up. Doesn't look too clean and clear in here, does it? It's okay. It's about to change. We're going to drop down the lower time frame because we have a bias. I mentioned on Monday that I felt that this was going to go higher and clear up all this here, and that was the draw on liquidity. This is what I dubbed relative equal highs. That right there engineers buy stops. For anyone that chases this going lower, they're going to think that this is the area where resistance is. So their stop will be placed above that. Does it take rocket science to understand that? No. Every book tells every trader that reads the book that stops get above the old high. And this is resistance because it went here, stopped, went lower. It tried one more time here and then went lower. So this is strong resistance. Now, granted, I'm not trying to make a case that hourly time frame is strong, okay? But there's a lot of people that trade in these lower time frames, and they'll see that as what? Formidable resistance. So they'll feel that this is safe. The market should keep going lower. They broke this low, so that means it's going to keep going lower. And when the price starts going sideways like this, slightly up, it's going to look like what to them? It's a bear flag. So they're going to look at this high down to that low and project that same movement lower as a measured move. And this type of thing happens because they didn't use the context that I'm providing you, understanding how the markets move from discount to premium, premium to discount. That's it. And then what PD arrays within the current market structure and what narrative. So what is narrative? What is that? Well, we have the market trading down into that short-term low, below old lows, about 50% of its daily range that I mentioned on the daily time frame. So we've purged the sell stops. Where's it going to go? Higher. Why? It needs to go to buy side because it's now collected sell stops. So smart money is going to do what? Offset those buy orders that they used to pair up with the sell stops below these lows. They bought those sell stops. So now they're net long. How do they get out? They have to sell them to willing buyers. But at this point down here and over here, who's going to be buying from them at a higher price? The buy stops that are resting above here. So you have to think algorithmically, how do you pair your orders? If you don't have this mindset going in before you click the enter button of your trade, you are gambling. You have no idea what you're doing. You're trying to guess. So the logic is we're looking for it to run above here. And now think about that in this area here. But now think about what does your daily candle look like if it's going to likely go up here and we're down here. It's going to create what? A little bit of a movement down, make the low of the day, then rally up to clean that low out. And we're not trying to predict the closing price on the daily candle. We're not trying to do that. We're trying to participate in a move in the morning session that gets us long, that allows us to run up into this area here, and that would be your target. You have to change your thought process about what you're looking at in the charts, and that is narrative. Looking for the daily delivery on that candle, Judas swing, buy below the opening price, expect displacement to the upside, run into liquidity, offset, sell to buyers, move to the sidelines, you're done. Now, what does that look like on a lower time frame? Here's the 15-minute time frame. All right, so here we have this low. Why am I picking that low? Why not that low, Michael? Why didn't you pick this low, Michael? But this movement here, this is the most recent swing low. It rallied up and it created a higher high right above these relative equal highs. So there, at 0.1 to 0.2, that's your dealing range, okay? I'm using that because it's the most energetic, most recent low and high. This is where I think the market's going to go up to because I think all of this movement down here basically is accumulated all the sell stops. So now smart money's heavily net long and they are sitting on all these, counterparty traders that either were knocked out of the marketplace and they absorbed all of their sell stops, or they're caught offside and retail's trying to go lower. It doesn't make a difference. I'm not suggesting that you should even waste any time trying to figure out what that is. I'm just saying that below old lows is sell stops, below old highs is buy stops. Just have it in mind. It's just that simple. Now, knowing that by itself is not enough. You need to know what is likely to occur. Here is the midnight candle in New York. Draw that out in time. And that's your New York midnight opening price. This is the price I want to preferably be buying below. Now, there are instances where the opening price will be lower, and then the market is trading higher, but doesn't go back below the midnight opening price. This is why I said 8:30 opening price. 8:30 is when a news embargo lifts, and a lot of news comes in around 8:30 typically, and I use that opening price there. Now, in this instance, this is why I'm teaching it to both groups today, because this is kind of like just a dandy of a setup. It means it's really good. I like these types of setups, what I'm going to show you here. When it delivers something like this, it's almost like it's presenting it to you on a silver platter. The confusion that you're getting about the opening prices at midnight and the opening prices at New York, 8:30 a.m. Last ditch for Power 3 is 8:30. What does that mean? If the opening price at midnight, if you're bullish, is lower than prices trading at around 8:30 or after 8:30, then it's likely it's not going to be a factor. Then you use 8:30. If there is a day like this one here, where we have the opening price at midnight here, we're already below it. And after 8:30, we're below it again, still below the midnight candle's opening price. We're really in a discount. Like, we're really, really cheap on the day when we're bullish. Now think about what I've outlined so far. Inside this range, it moved from here to here and then started retracing down after midnight. Notice that? So all of this here is a Judas swing. Judas swing is the move that's opposite to what you expect the daily range to be. So if we're bullish and we think it's going up here, we like this movement going down. We love it. Now, you may not feel comfortable buying the London or overnight lows. That's fine. You don't need to. Wait for 8:30. If we drop below 8:30's opening price, and here's the kicker, we're below the opening price at midnight too, we are really, really oversold. Does it take indicators to see that? No. Visually see what's being shown here. Below the opening price, you want to be a buyer at midnight. By itself, that's always the basis of what I'm trying to do each day. Then, if we get an 8:30 candle that opens below the midnight candle, and then we have a movement below that, that move here also is like a micro Judas swing for the session of New York. This is a Judas swing on the daily range or the daily candle. So this is basically building the low of the daily candle. This is building the low of the New York session. Both are using the Power 3 concept, which is accumulation, manipulation, distribution. So what we're saying is this movement below the opening price at 8:30 and below the opening price at midnight, each move lower is the trap. It's the snare that catches traders thinking it's going down. We are looking for that. We're looking for that drop down, not just any old indiscriminate drop in price. We're looking for a very specific thing. Now I'm down into a 5-minute chart. Same things I had on a 15-minute time frame, I now have just showing and representing it on a 5-minute chart. I want you to take a look at price, study, think about what you see in price action here. Right there. See that fair value gap right there? See these two down closed candles? That's your order block. That's bullish, your fair value gap. At 8:30, we have a drop down. At 8:30, we're looking to the left and see where are our short-term swing lows, because we want to absorb sell stops, because smart money will pair that with their buys. And we're looking for an imbalance preferably. And we just happen to have it also with an order block. So we have a lot of things happening here. It comes down, hits it, and then rallies. 8:30, opening price. We find it come back down into it, finds some support, and it springs aggressively above these short-term highs. By itself, that right there is enough. That's a beautiful run on S&P, and that would be enough. You don't need to have the objective up here. But if you're holding it for the daily range, you're going to wait for it to reach up in here, and it does so here. Now, in this area here, notice what happens. It rallies up and consolidates during lunch, and around the 2 o'clock hour, going to the 3 o'clock, we run back down into sell stops. Traders that have trailed their stop loss up because they don't want to lose any of their profits, and then they pump it one more time up into the PM session or afternoon move into the liquidity that was outlined relative equal highs on the 15-minute time frame. Here is the 1-minute chart. How can you apply what I've been teaching you on the YouTube model? Well, here it is. Here is the low forming. And now find the setup that would occur with the YouTube model. So in other words, we're seeing a movement here. The bias is bullish. We're looking for a continuation on the upside. We have a target based on that 15-minute time frame, relative equal highs. What does the model I'm teaching on YouTube, where does that exist here? Okay, the market has a run above this short-term high. So we have a shift in market structure that's bullish. What's this? Fair value gap. It trades down into it, hammers it, 3 consecutive down closed candles. That's what? Your order block. All consecutive, because we're looking at 1-minute candles. That is the order block with a fair value gap. Buy it there. And then comes back down, retests, sends it higher. And then one more time, New York midnight candle opening price, opportunity again. Trades up into the New York midnight opening candle, trades back into another gap, trades into the midpoint of that, rallies up, consolidates, and then expands up into our objective that was outlined in that 15-minute time frame, the relative equal highs.